Oregon's 2025 housing market isn't crashing, it's locking up. A slow-motion freeze, sharper and more punishing than most expected, is spreading through the state. The statewide median still hovers in the low $500,000, but buyers have thinned and listings have climbed double digits as sales timelines stretch. The affordability gap has blown wide open. With mortgage rates stuck north of 7%, owning a home now pencils out as a budget breaker for anyone short of top-tier incomes. Foreclosure activity is edging higher, and houses that used to move in a weekend are taking roughly a month to sell, often after painful price cuts. Welcome to the ghost town phase of a frothy cycle. Once booming neighborhoods drifting toward regret as momentum drains away. Today, the spotlight turns to 10 Oregon cities sitting at the epicenter of this market stall, and the early reads are chilling. For ongoing breakdowns like this, consider subscribing so the next update hits the feed the moment it drops. Number 10. Eugene. Eugene's eco-minded college town Polish once signaled stability. In 2025, hairline cracks are showing through the shine. The average home value sits around $479,748, roughly a 2% uptick year over year. But the sales engine is sputtering as closings drop more than 10%, and typical market time stretches to about 42 days from 29 a year earlier. Pricing tells the rest of the story. More than 40% of active listings have taken at least one cut, a clear sign sellers are recalibrating expectations to meet thinner demand. Layer in the math on ownership and the strain is obvious. On a median household income near $58,000, a 7% mortgage puts a typical payment north of $3,800, a burden most budgets can't absorb. Speculators from the frenzy era are feeling the whiplash too, as absorption slows and units sit, carrying costs bite. Some properties linger vacant while owners wait out the market. City documents add another pressure point. Meeting stated housing targets would require roughly 1,600 new units per year. Output Eugene hasn't come close to sustaining. The University of Oregon still anchors rental demand, but the for-sale ladder is sliding out of reach for many would-be owners. The result is a market that feels stalled, visible momentum on the rental side, mounting hesitation on the purchase side, and a growing sense of paralysis for households trying to bridge the gap. Number 9. Astoria. Astoria's postcard promise, Victorian streets, river views, maritime lore, fueled a run-up that felt untouchable. In 2025, the tide has turned. The median sale price sits near $464,950, down roughly 15.5% year over year, and momentum has cooled across the board. Homes that once moved briskly now take longer to catch a bid, with median days to pending stretching to about 51 from 36 a year ago, and overall sales volumes slipping. The demand side is straining under basic math. With typical household incomes around the $70,000 mark, a payment on a $500,000 purchase at roughly 7% is a budget breaker for many households. As affordability bites, transactions thin out and listings linger, pushing more sellers to trim asking prices to meet the market. It isn't just prices, it's pace. July data shows sales down about 17.6% from the prior year, and the share of homes needing cuts has risen as time to contract lengthens. Even as list metrics can differ across sources, the through line is clear: fewer closings, slower absorption, and a reset in pricing power toward buyers. Astoria's coastal cachet once insulated it from broader state trends, but that buffer is eroding as Oregon cools. With activity softening and days to pending climbing, the city looks increasingly exposed to the same forces reshaping markets statewide, a compelling case study in how quickly desirability can give way to discipline. Number 8. Bend. Bend's master-planned polish and outdoor luxe lifestyle made it a magnet for high-income families and remote pros. By the peak, median sale prices pushed into the low $700,000. In 2025, the sheen is slipping. Median listing sits in the high $800,000 to low $900,000 and is trending down about 4.3% year over year, while sales volumes have cooled and market time has lengthened toward the high 40s days range versus last year's upper 30s. Discounting has become standard operating procedure. Roughly half of active listings are taking cuts in recent months across Central Oregon snapshots, and local reports show active inventory swelling to multi-year highs, giving buyers leverage and forcing sharper price discovery. The affordability math is punishing. With median household income near the $80,000 mark and mortgage rates around 7%, carrying costs on higher price segments can jump into mid-four-figure territory monthly, well beyond comfort for many would-be move-ups. As a result, absorption is uneven. Million-plus homes show many months of supply, while lower price brackets still move faster. Lesson learned: even destination markets aren't immune to a freeze. Bend's reputation for resilience meets a reality of more inventory, longer timelines, and widespread price trims, proof that no enclave, however exclusive, escapes the broader reset. Number 7. Salem. Salem, the state capital, drew households priced out of Portland with a promise of relative affordability and government-anchored stability. In 2025, that narrative is fraying as sales pace slows and pricing power shifts. Zillow's Red puts the average home value in the mid-$440,000 with year-over-year change hovering near flat, while time on market has lengthened toward roughly 40 days, and the share of listings with reductions has climbed into the mid-30% range. The affordability math is pushing buyers to the sidelines. With median household incomes around the mid-60s and mortgage rates near 7%, modeled payments on median-priced homes stretch debt-to-income ratios beyond comfort for many households. Stress signals are emerging in distress metrics as well, with reports of foreclosure activity edging higher across Oregon metros in 2025, reflecting budget strain as holding times and carrying costs rise. Salem's employment mix, heavy in government and healthcare, provides job stability, but not the wage growth needed to offset higher borrowing costs and insurance, keeping would-be purchasers cautious as inventories accumulate. Population estimates indicate modest growth driven by net in-migration of working-age adults, yet that cohort increasingly finds ownership out of reach at today's prices and rates, reinforcing a rent-tilted demand profile. The result is imbalance, a pool of aspiring buyers with insufficient purchasing power facing sellers reluctant to accept materially lower prices, producing longer marketing times and more aggressive price discovery. Salem now sits between its former value proposition and a tougher near-term reality, an affordability wall, slower absorption, and a market that feels stuck until incomes, prices, or rates meaningfully reset. Number 6. Corvallis. Corvallis, powered by Oregon State University and a tight tech research ecosystem, earned a reputation for stability. In 2025, the surface still looks steady, but under the hood, the tempo has shifted. Headline prices are roughly flat to slightly higher year over year on some reads, yet deal flow has thinned and timelines have stretched materially, a telltale sign of cooling demand. On pricing prints, Redfin shows a recent median sale around the low to mid $500,000 with modest year-over-year change, while local MLS recaps flagged earlier year slippage versus 2024. At the same time, closings are running lower than last year, and average days to sell has moved toward the 6 to 7 week mark. That gap between price stickers and absorption points to sellers meeting the market more often via concessions and cuts. Listing behavior backs it up. Several Corvallis snapshots show longer listing ages than a year ago, and a higher share selling under ask even as a minority of hot properties still draw multiple offers. The through line: fewer sales, more time on market, and more price discovery as buyers regain leverage. Affordability is the constraint. With median household income near the approximately $70,000 band, A 7% mortgage on a typical purchase can push monthly payments into the low $4,000, depending on down payment and taxes, an uncomfortable debt to income profile for many families. That tension is freezing move-up activity, especially among owners locked into ultra-low 2021 rates who are reluctant to list, while some investors wrestle with longer vacancies as absorption slows. The net effect is a market that still sparkles on curb appeal, but feels short on momentum. Fewer closings than a year ago, longer timelines, and wider gaps between initial list and final contract. Even resilient university towns aren't fully insulated from a high-rate freeze. Corvallis is now contending with exactly that reality. Number 5, Gresham. Gresham, long the affordable pressure valve east of Portland, rode a family-focused boom. But 2025 finds momentum fading as sales slow and pricing power tilts toward buyers. Recent reads put the median sale price near $485,000, down roughly 2.1% year over year, signaling a modest but notable step down from last summer's levels. Throughput has weakened too. July year-over-year sales volumes fell by about 18%, and the typical time to get under contract stretched to roughly 45 days from about 38 a year earlier. Affordability is the bind. With Multnomah County household incomes around the upper $80,000 and mortgage rates hovering near 7%, payments on median-priced homes push many buyers past comfortable debt-to-income thresholds. Even as the metro continues to grow modestly, the value halo that once insulated Gresham is dimming as Oregon-wide conditions cool and inventory sits longer, pulling the suburb into the same gravity as the rest of the state's market. Number 4, Hillsboro. Hillsboro, the heart of Oregon's Silicon Forest, was long considered an unshakable powerhouse, driven by tech giants like Intel. This job market stability fueled relentless demand. But in 2025, even Hillsboro is facing a troubling transformation. The median home price is $517,000, a significant drop of 5.5% in the past year. With mortgage rates above 7%, monthly payments on a median home surpass $4,400, while median household income in Washington County is $98,000. That gap is forcing many buyers to delay or leave. Inventory has ballooned, with active listings increasing 20% year over year. The average home now stays on the market 50 days, up from just 35 2 years ago. Roughly 38% of homes have price cuts, and foreclosure activity is up 25%, especially among those who purchased with minimal equity in the frenzy of 2021 and 2022. The forces that built Hillsboro's housing boom are now working in reverse. Number 3, Beaverton. Beaverton's suburban sheen, top-rated schools, parks, and adjacency to marquee employers kept it on safe haven shortlists. In 2025, the surface holds while the engine slows. Recent reads put the median sale price around the mid-$500,000 with roughly 1% year-over-year change, a far cry from the rapid gains of prior cycles. Throughput and tempo tell the deeper story. Closed sales have run notably lower than last year, and typical time to get under contract has stretched into the multi-week range, on some cuts of the data pushing well beyond a month, while parallel list-side gauges show asking prices easing a couple of percent year over year as sellers meet the market. Affordability remains the constraint. With area household incomes in the mid-$90,000 and mortgage rates hovering near 7%, modeled payments on a median-priced purchase land north of the mid-$4,000, including taxes and insurance for many scenarios, a level that pushes debt-to-income ratios past comfort for a broad swath of buyers. The net effect is stasis. Fewer move-ups as low-rate owners stay put, more vacant-to-listed churn for investors facing slower absorption, and a seller's market giving way to buyer leverage and price discovery. The dream hasn't vanished, but the pace and pricing that defined it have clearly downshifted. Number 2, Lake Oswego. Lake Oswego's gilded aura, lakefront addresses, top schools, and prestige pricing hasn't insulated it from a 2025 slowdown. Recent reads put the median sale price around the mid to upper $800,000, roughly 3 to 4% lower than a year ago, while marketing times have stretched deep into the multi-month range for many listings. Supply and seller behavior underscore the shift. Active inventory is materially higher than last year, and a large share of listings are taking reductions as sellers meet a thinner buyer pool at today's borrowing costs. In the upper tiers, longer days active and larger negotiated discounts are showing up more frequently in deal logs and brokerage recaps. Affordability dynamics at the luxury level are biting. Even high-income purchasers are sensitive to 7%-ish mortgage rates, pushing some to pause or negotiate harder. As a result, aspirational list prices are giving way to bigger concessions, longer timelines, and occasional six-figure spreads between ask and close. The takeaway: beauty and brand cachet still matter, but the cost of capital matters more. With inventory elevated and rate-driven demand tempered, Lake Oswego's market is trading some of its impenetrable fortress mystique for a more negotiable, sois, d'abord necromancy, slower-moving reality in 2025. Number 1. Portland. On paper, Portland still looks strong. Median price near $545,000. But beneath the surface, the foundation is slipping. Slowly and relentlessly. Homes now take 22 days to sell, up 4 days from last year, and nearly 4 in 10 listings are cutting price across the metro. Sellers are losing power. Affordability? Broken. At today's rates, the monthly on a median-priced home pushes past $4,500, taxes and insurance included. Even with higher metro incomes, that math shuts the door on most buyers. The result is a quieter market, more listings, longer waits, and offers that grind instead of sprint. Layer in job losses in high-paying sectors, and a commercial real estate hangover, with office vacancies north of 20%, and confidence slips further. Portland still glitters. But under the lights, it's oversupply, weakened demand, and an economy straining to carry the weight. Downbeat. This isn't a crash, it's a choke. And unless rates fall or incomes rise, the city's leverage keeps shifting toward the buyer. Final message: Oregon's housing market isn't on the brink of a California-style crash. Supply remains too tight for a free fall. But the system is seizing up in slow motion. Activity has thinned. Inventory is up from the lows. And willingness to transact has cooled. It's a freeze, not a fall. Homes aren't moving fast. Time on market has stretched. Price cuts are more common. Negotiation power is shifting away from peak seller norms towards something closer to balance. Affordability, crushed by rates in the 6 to 7% range, is the ceiling over demand. The ownership dream is slipping further for median earners. Rents and prices outpaced wages through the last cycle. More than half of every new wage dollar in recent years was absorbed by housing costs. Many households have gone from stretched to priced out. Key dynamics to watch: rates and payments. Even modest rate relief changes monthly payments materially. Without it, move-up chains stall, and first-time activity remains thin. Expect gradual easing, not a snapback to ultra-low financing, which keeps demand capped. Inventory normalization, not glut. New listings have improved versus the trough. Some new build pipelines are restarting, but Oregon still runs structurally short on units. That shortage is a floor under prices, and the reason this is a freeze, not a crash. Negative equity risk is local, not systemic. A 2008-style wipeout is unlikely, but neighborhoods with faster inventory build or heavy 2021 to 2022 minimal down purchases face higher downside and equity risk. It's a scalpel, not a sledgehammer. Investors stepping back. Their share has slipped as returns compress and holding times lengthen. That removes marginal demand that once bid up entry-level stock. It can help end users, but it also cools price support at the bottom tier. renting pressure persists. With ownership costs elevated, rent demand remains resilient in core metros despite economic noise. That helps underpin multifamily cash flows. Even as cap rates adjust, labor and offices, high-paying job uncertainty and office market stress weigh on sentiment. Elevated vacancy and slow leasing in Portland's office sector are a macro overhang for nearby residential. Migration and lifestyle, the very tailwinds that built the boom, aren't the same today. Net in-migration has cooled from peak years. Remote work math is settling, and the state's cost profile is pushing some would-be buyers into longer rental stints or out-migration altogether. That removes urgency. If this analysis hits home, subscribe and turn on notifications. Don't miss the next video.